The Remarkable Life and Legacy of Warren Buffett. Lessons from the Oracle of Omaha. Warren Buffett, often called the Oracle of Omaha, is a name synonymous with investing success and financial wisdom. From humble beginnings to becoming one of the richest people in the world, Buffett's life story offers invaluable lessons in persistence, frugality, and strategy. In this video, we'll explore the extraordinary journey of Warren Buffett, uncovering how his investments, decisions, and values turned him into a global role model for millions of investors. Who is Warren Buffett? Born in 1930 to Howard and Layla Buffett in Omaha, Nebraska, Warren Edward Buffett displayed an uncanny knack for numbers and business from an early age. Childhood talent. Known as a mathematical prodigy, Warren could add large columns of numbers in his head, a skill that foreshadowed his future in finance. Ambition. At a young age, he told a friend that if he wasn't a millionaire by 30, he'd jump off Omaha's tallest building. Luckily for us, he didn't have to. Let's dive into how Buffett built his empire. First investment at age 11. Warren Buffett's investment journey began at just 11 years old when he bought his first stock. 3 shares of Citi Service Preferred at $38 each. Early lesson in patience. Buffett sold his shares when the price rose to $40, making a small profit. However, the stock later soared to $200 per share. This taught him the importance of patience in investing, a principle he would carry throughout his life. Teenage entrepreneur. By age 13, Buffett had already started building his financial base. Paper route. Waking up at 4:30 a.m., he delivered copies of the Washington Post. On the side, he sold magazine subscriptions and calendars to his newspaper clients. By 15, he had earned $2,000, equivalent to $26,000 today. Investments. At 15, Buffett used $1,200 of his earnings to buy 40 acres of farmland in Nebraska, entering a profit-sharing agreement with a local farmer. Pinball machine business. At 17, Buffett and a friend invested $25 in a used pinball machine, placing it in a barbershop. The business quickly expanded to multiple locations, earning them $25 per week before being sold for $1,000. Education and early career. Buffett's academic journey shaped his investing philosophy. University of Nebraska. Graduated with a Bachelor of Science in Business Administration. Rejection from Harvard. After being rejected by Harvard Business School, Buffett enrolled at Columbia Business School upon learning that Benjamin Graham, the father of value investing, taught there. Mentorship under Graham. Buffett earned his Master of Science in Economics in 1951 and later worked for Graham in New York. During this time, Buffett also took a Dale Carnegie public speaking course, which helped him gain confidence and begin teaching investment courses at night. Starting his own partnership. In 1956, after Benjamin Graham retired, Buffett returned to Omaha to establish his own investment firm, Buffett Partnership Limited. Unique conditions. Buffett initially asked a doctor friend to find 10 other doctors willing to invest $10,000 each. 11 doctors agreed. Buffett invested only $100 of his own money initially, but reinvested his management fees to grow his stake. Growth. By 1960, Buffett managed 7 partnerships with over $1 million in assets. By 1962, he became a millionaire, managing partnerships worth over $7 million. $1 million of which belonged to him. The turning point. Berkshire Hathaway. Buffett made his most famous acquisition in 1962. Berkshire Hathaway, a struggling New England textile company. Initial investment. Buffett began buying shares after a dispute with management. Challenge. Despite his efforts, the company continued to lose money, and its textile business was clearly declining. Strategic shift. In 1967, Buffett made a radical decision to pivot Berkshire Hathaway from textiles to investing in other businesses. Insurance companies. Buffett used cash flow from Berkshire's new insurance subsidiaries to fund further investments. Result: this marked the transformation of Berkshire Hathaway into a holding company, laying the foundation for its success. Today, Berkshire Hathaway owns over 1,000 companies, with total assets exceeding $700 billion. Becoming a billionaire. In 1990, Berkshire Hathaway began selling Class A shares, officially making Buffett a billionaire. Notable investments. Buffett focused on long-term, value-driven investments in companies like Coca-Cola, Apple, and American Express. Wealth growth. Today, Warren Buffett is worth over $100 billion, making him one of the richest people in the world. Buffett's frugal lifestyle. Despite his immense wealth, Buffett lives a remarkably modest life. Home. Buffett resides in the same Omaha house he purchased in 1958 for $31,500, around $315,000 today. He famously avoids mansions and luxury properties, choosing instead to live simply. Daily routine. Buffett starts his mornings with a $3.50 McDonald's breakfast. He prefers spending time reading, learning, and making investment decisions. Lesson: Buffett's lifestyle demonstrates the power of frugality and focusing on what truly matters. Philanthropy, giving back. Warren Buffett is as famous for his generosity as he is for his investing acumen. The Giving Pledge. In 2010, Buffett co-founded the Giving Pledge with Bill Gates, encouraging billionaires to donate most of their wealth to charity. Buffett has pledged to give away 99% of his fortune. Notable donation. Buffett donated $28.3 billion worth of Berkshire Hathaway shares to the Bill and Melinda Gates Foundation, one of the largest charitable contributions in history. Impact. Through his philanthropic efforts, Buffett has not only shared his wealth, but also inspired others to think beyond material success and focus on making a difference. Timeless lessons from Buffett. Warren Buffett's life is a masterclass in investing and personal finance. Here are key takeaways. Start early. Buffett began investing at 11, giving him decades to compound his wealth. Be patient. His early lesson with City Service Preferred taught him the value of holding investments long-term. Live modestly. Despite his wealth, Buffett prioritizes value over luxury. Seek mentorship. Learning from Benjamin Graham shaped Buffett's philosophy of value investing. Focus on the long term. Buffett avoids speculation, instead focusing on companies with solid fundamentals. Give back. True wealth isn't just about money. It's about making a positive impact on the world. Conclusion: a legacy of wisdom. Warren Buffett's journey from a paperboy in Omaha to the Oracle of Omaha is an inspiring tale of hard work, discipline, and vision. His principles, start early, invest wisely, and live modestly, are lessons we can all apply in our lives. Call to action. What's your favorite lesson from Warren Buffett's life? Let us know in the comments below. That's all for now. Don't forget to like, subscribe, and hit
a land where economic history reads like a suspense novel, the Netherlands. You might think of tulips and windmills, but there's so much more beneath the surface of this small but mighty nation. The Dutch didn't just stumble into modern economics, they practically wrote the first chapters. Picture this. Centuries ago, they were already mastering international trade, setting up corporations, and yes, even pioneering financial markets. But it wasn't all smooth sailing. They've seen boom and bust cycles so wild, it makes today's stock market swings look like a mild roller coaster ride. Fast forward to now, and the Netherlands isn't just keeping up, it's leading the pack in productivity. Think of it as the productivity champ of Europe, rubbing shoulders with economic heavyweights like the USA. But here's the kicker. They've managed to achieve this while still prioritizing quality of life. Imagine a country where part-time work isn't just common, it's the norm. Thanks to a culture that values a well-rounded life over workaholic tendencies, the Dutch have nailed the art of balancing output with happiness. And let's talk resources. The Netherlands sits on a gold mine of natural gas, enough to make any economy drool. But here's where it gets interesting. They've chosen to leave a significant chunk of it untapped. Why? Environmental concerns and a little thing called Dutch disease, where reliance on one industry can backfire spectacularly. Speaking of which, their history reads like a cautionary tale for other economies. They've learned the hard way not to put all their eggs in one economic basket. It's a lesson in diversification that many could stand to learn from. So, how did they pull it off? It's a mix of foresight, adaptability, and a knack for balancing risk and reward. The Dutch aren't just thinking about tomorrow, they're paving the way for it, all while ensuring today is pretty darn good. In a world where economic success often comes at the expense of well-being, the Netherlands stands out as a beacon of how things can be done differently. It's not just about GDP numbers here, it's about human development indices that soar and a society that values progress without leaving anyone behind. So, why does the Netherlands do things so differently from other wealthy nations? And should their model be a blueprint for others to follow? The Dutch approach is a tale of pragmatism and foresight. They've long understood that economic success isn't just about raw output. It's about quality of life and sustainability. Unlike some economies fixated on relentless growth, the Netherlands prioritizes balance. They've mastered the art of fostering a productive workforce while ensuring people have time to enjoy life, a model where part-time work isn't a compromise but a choice. And should other major economies follow suit? Well, the Dutch model offers a compelling case. It's a testament to how a strong financial sector can fuel growth without sacrificing stability. Amsterdam's historic stock exchange isn't just a relic, it's a testament to their commitment to long-term investment and economic resilience. So, should we put the Netherlands on the Economics Explained leaderboard? Absolutely. Their blend of economic prowess, societal balance, and historical resilience makes them a standout example in today's global landscape. Whether it's their commitment to sustainable growth or their innovative financial strategies, the Dutch model offers lessons that transcend borders. In a world where economic paradigms are constantly evolving, the Netherlands stands as a testament to what's possible when innovation meets prudence. So, whether you're an investor looking for opportunities or simply curious about the forces shaping our economies, keep an eye on the Dutch. They're rewriting the rulebook, one tulip at a time. At its peak, the Dutch merchant fleet was a behemoth, dominating European shipping with a capacity that rivaled half of the continent's total. The Dutch East India Company in particular stands as a pioneer of multinational enterprise, but let's put things in perspective. Claims of its astronomical value, like a $7 trillion market cap in today's terms, are often exaggerated. To contextualize, that would be like Apple today having a market cap of $700 trillion. Unthinkable. The wealth of the 17th century was a drop in the ocean compared to today's global economy. Adjusting historical figures to modern standards is fraught with challenges, and other companies of the time, like the Mississippi Company, had higher market valuations, albeit under dubious circumstances. But beyond the history lesson, these early Dutch ventures laid the groundwork for modern economic strategies. Despite setbacks, including French occupation and the loss of Belgium, the Netherlands adapted. By the 19th century, they embraced industrialization and leveraged a business-friendly environment to regain footing. Fast forward to the aftermath of World War II, and another twist, the discovery of vast natural gas reserves. It seemed like a windfall, a boon for an energy-hungry Europe. However, this discovery wasn't without its downsides. Enter Dutch disease, a term coined when a sudden resource boom disrupts a nation's economy, leading to over-reliance and neglect of other sectors. The Netherlands faced a dilemma: how to harness newfound wealth without succumbing to economic imbalance. Their solution? Strategic investment in infrastructure and technology, ensuring that prosperity was shared across society. It's a lesson in managing abundance responsibly, a balancing act between short-term gains and long-term sustainability. Dutch disease, a phenomenon where a sudden resource boom can disrupt an economy, is a cautionary tale. Yet, the Netherlands managed it better than most, leveraging their existing wealth to mitigate its impacts. They taxed short-term gains from natural resources to fund long-term investments in diverse industries, a strategy that's harder to implement in poorer countries where immediate gains could drastically improve quality of life. Today, the Netherlands shines as an economic powerhouse, driven by a diverse range of high-value industries. Its allure for global businesses is undeniable, offering a business-friendly environment coupled with a robust legal system and a multilingual workforce. This combination has made it a strategic hub for international operations within the European Union. But what truly sets the Netherlands apart isn't just its economic prowess. It's their unique blend of business acumen and egalitarian values. Part-time work isn't a compromise here. It's a choice supported by legislation that promotes work-life balance without penalizing career progression. This approach has elevated labour force participation rates, even surpassing the workaholic culture of the USA, all while maintaining a generous social safety net. Moreover, the Netherlands proves that economic success doesn't require overworking its people. Instead, it champions a balanced approach that values both productivity and well-being, a luxury few economies afford. Now, while the Dutch model may not be easily replicated elsewhere due to unique historical advantages and infrastructure, it offers valuable insights. It shows how strategic investments, prudent economic policies, and a supportive regulatory framework can foster long-term prosperity. The Netherlands may be small in land mass and population, but with a GDP of over $1.1 trillion, it's the 17th largest economy globally. Given its size and output, the Dutch economy scores an impressive 8 out of 10. However, growth has been lackluster. Despite resilience, the country struggled through the Eurozone crisis and subsequent slowdowns. Recent trends are positive, but with sluggish growth averaging around 1% annually over the past decade, it scores a 3 out of 10 in this category. The Netherlands has successfully diversified beyond natural resources to tourism, finance, trade, and high-yield agriculture. This resilience earns it an 8 out of 10, noting its smaller footprint in global corporate giants. With an average score of 7.6 out of 10, the Netherlands secures a strong position on the Economics Explained leaderboard. Its blend of productivity, stability, and strategic industry focus showcases a model that balances tradition with innovation. Thanks for watching. Please like the video, press the subscribe button, and also drop your thoughts in the comment section. Imagine knowing the secrets of a man who predicted the 2008 financial crisis and turned it into a fortune. Michael Burry, the legendary investor immortalized in The Big Short, is back with bold new moves in the stock market. What could he possibly be seeing that others don't? Brace yourself as we dive into his latest 13F filing to uncover the secrets of his portfolio and what it might mean for the rest of us. First off, for those of you who might be new here or need a quick refresher, Michael Burry is the genius who predicted the 2008 housing crash. His story was so captivating, it became a movie called The Big Short. Now, Burry is known for his sharp, often contrarian investment strategies. And when he makes a move, the financial world pays attention. Burry just released his latest 13F filing. This document is like a peek behind the curtain, showing us what stocks he's buying and selling. Usually, Burry's moves can seem all over the place from one quarter to the next, making it tricky to pin down a clear strategy. But this time, two strong themes have emerged, giving us a bit more to chew on. Inflation. Remember when we thought we were getting inflation under control? Well, Burry seems to think otherwise. He's betting big on another wave of inflation hitting us in 2024. Why? Burry believes that the economic measures taken to curb the initial wave of inflation might not be enough, and we could be in for a second round. And if history has taught us anything, it's that when Burry makes a prediction, it's wise to listen. Now, digging into the specifics, Burry's portfolio shows some interesting shifts. He's heavily investing in commodities and companies that tend to perform well during inflationary periods. Think of sectors like energy, agriculture, and basic materials. These are the industries that can pass on higher costs to consumers, making them a safer bet when prices are rising across the board. One standout move is Burry's increased stake in oil and gas companies. With the global energy landscape being as volatile as it is, and with supply chain issues still making headlines, this move suggests he's anticipating higher energy prices. And higher energy prices often signal broader inflationary trends. But that's not all. Burry is also eyeing agricultural stocks. Why? Because food prices are a major component of inflation. As the world grapples with climate change and supply chain disruptions, agricultural commodities are likely to see price hikes. Burry's bet here is that these stocks will benefit as food costs soar. Now, let's address the elephant in the room. Is Burry's prediction something we should all be worried about? Well, he's been right before, and his track record speaks volumes. But it's also important to note that the market is unpredictable. While Burry is positioning himself for what he sees as an inevitable second wave of inflation, we need to consider other factors too, like potential government interventions and global economic shifts. So, what does this mean for the average investor? Should we all start buying up commodities and energy stocks? Not necessarily. While it's intriguing to follow Burry's moves, it's crucial to do your own research and understand your own risk tolerance. Diversification is key, and jumping on trends without a solid plan can be risky. Now onto the specifics of his recent activity. Burry has been doing a lot of chopping and changing in his portfolio. He sold out of 14 stocks, including big names like Google, Amazon, and Oracle. At the same time, he added to 11 positions and bought 5 new stocks entirely. Here's where it gets really interesting. One of these new additions is the Sprott Physical Gold Trust. In Q1, Burry bought over 440,000 shares, making up 7.37% of his US portfolio. Now, you might wonder why he's buying into gold when prices are already high. Well, gold is a classic hedge against economic uncertainty and inflation, two things Burry is very concerned about. Sprott Physical Gold Trust is a closed-end fund that holds assets in physical gold bullion. With gold prices at near all-time highs, this move might seem odd for a value-minded investor like Burry. However, gold is a safe haven during times of economic instability and market volatility, something Burry has been vocal about. His investment in Sprott aligns perfectly with his long-standing concerns about economic conditions. Now, historically, gold has been a go-to asset during economic uncertainty. Its price spiked during the Great Depression, skyrocketed in the 70s, for reasons we'll discuss shortly, and surged after the tech bubble burst, the 2008 financial crisis, and more recently during the COVID-19 pandemic. While much of gold's appeal is psychologically driven, the trend is undeniable, and Burry is banking on this uptrend continuing since October last year. With all that's happening globally, from tariffs and elections to wars, supply chain disruptions, and rising inflation, gold is an attractive hedge. Beyond economic downturns, investors flock to gold for its stability. It's a similar story to why Burry is increasing his positions in commodities and agricultural stocks. In summary, Michael Burry is back and making bold predictions once again. His latest 13A filing reveals a clear strategy aimed at preparing for a second wave of inflation in 2024. By investing heavily in commodities and industries that thrive in inflationary times, Burry is positioning himself to potentially profit from what he sees as an inevitable economic shift. Michael Burry has a significant investment in JD.com, which is the largest stock in his US portfolio. This investment is worth approximately $99,986 million. However, considering his estimated total fund size of $238 million, JD.com represents just about 4% of his overall portfolio. While this is a substantial investment, it is not overwhelming in the context of his entire fund. More interestingly, Burry appears to take a cautious approach to investing. It is estimated that around 52% of his portfolio is allocated to US Treasuries. This large allocation suggests that Burry is being careful amid the current market volatility, preferring the relative safety of government bonds over more volatile equities. It's important to understand that the information about Burry's investments comes from 13F filings. These filings provide a snapshot of his US portfolio at a specific point in time, but they have limitations. For one, they only cover his investments in the United States, meaning any international investments he holds are not included. Therefore, the 13F filings do not give a complete picture of Burry's entire investment strategy. In addition to the limitations of the 13F filings, these documents only show what Burry held at the end of the reporting period. They do not account for any changes made shortly before or after the filing. Given these factors, it's essential to consider the broader context when analysing Burry's investments. His significant holding in JD.com and the substantial allocation to US Treasuries indicate a balanced strategy. On one hand, he is investing in a major Chinese company, reflecting confidence in its growth potential. On the other hand, his large investment in US Treasuries shows a preference for stability and caution, likely as a hedge against market uncertainty. Thanks for watching. Please like the video, press the subscribe button, and also drop your thoughts in the comments section.